All right, let's talk C3.ai. We're breaking down their huge Q2 earnings call from December 3rd. And look, this wasn't your average report. It was really the first big stress test for the new CEO's plan to turn things around, and frankly, the results had a bit of a split personality.
So here's how we're going to break it all down for you. We'll start with the big headlines, then we'll dig into the financials to see what's really happening under the hood. From there, we'll check out management's new game plan, see how the market took the news, and then we'll wrap up with our take on what's next.
Okay, first up, the Q2 readout. And honestly, the best way to describe this quarter is as a complete bundle of contradictions. It really paints a complicated picture.
I mean, look at this. It's a perfect split. On one hand, you've got some really promising green shoots, a nice earnings beat, a massive jump in bookings, which is basically future business, and their federal segment is on fire. But then you've got some serious red flags waving. Revenue actually dropped more than 20% from last year, and the company is still burning through a ton of cash. And that is the core puzzle everyone on Wall Street is trying to solve right now.
Okay, so let's peel back the layers and dive into the financials. This is where the numbers really start to tell the story of that tug of war we just saw.
So, starting with the bottom line, there was actually some good news. C3.ai lost 25 cents per share, which sounds bad, but it was way better than the 32-cent loss analysts were braced for. That's a solid beat, and it shows they might be starting to get a handle on their costs. But here's the number that really got people talking: bookings. They hit about $86 million, which is up a staggering 49% from just the previous quarter. You gotta remember, bookings are a sneak peek at future revenue, so seeing that kind of acceleration is exactly what the bulls wanted to see.
And how'd they pull that off? Well, it's all about leverage. A massive 89% of that new business came through their big partners like Microsoft and AWS. This is huge because it shows their strategy of riding the coattails of these cloud giants is absolutely working.
Okay, and this is a big but, the revenue story is where things get a little messy. Yeah, revenue grew 7% from last quarter, which is good. The problem? It's still down over 20% from the same time last year. This year-over-year drop is the number one thing weighing on this stock.
Now, inside that messy revenue picture, there is one shining star: the federal business. It grew an incredible 89% year-over-year, and it now makes up almost half of all new deals. It's pretty clear that, right now, the government is their main growth engine.
So, with this really mixed bag of results as the backdrop, you can bet all eyes were on the new CEO, Stephen Ehikian, and what his plan is to right the ship.
And on the call, he did not pull any punches. I mean, he just came right out and said it. Sales execution fell off. It was totally unacceptable. That kind of blunt honesty is refreshing, and it signals a major shift toward getting the fundamentals right. His plan really comes down to three things. First, just plain old relentless discipline in how they sell. Second, focus. Stop trying to be everything to everyone and just win in the areas where they're already strong, like federal and energy. And third, get much better and faster at turning small pilot projects into those big, juicy, long-term contracts. But, a plan is one thing, the official forecast is another, and this is where management pumped the brakes a bit. The guidance they gave for next quarter and the full year is, well, it's pretty flat, and they're still expecting to lose a lot of money. This turnaround isn't going to happen overnight.
So, how did Wall Street digest this really complicated report? Well, as you might guess, it was a total roller coaster. The reaction was just as conflicted as the numbers themselves. I mean, just look at the stock's journey on earnings day. It rallied pretty hard into the report, suggesting traders were feeling optimistic. But once the call started and they heard about that weak revenue and flat guidance, all those gains just melted away in after-hours trading. And you really have to zoom out to get the full picture here. This one day happened against a backdrop of awful performance. The stock has been absolutely crushed this year, down almost 60%, while the rest of the market has been booming. That just raises the stakes for this turnaround. So what's the final verdict from the market? It's pretty clear. It liked the good stuff, the earnings beat, the strong bookings, but it punished the bad stuff, the shrinking revenue and weak forecast. The bottom line is, C3.ai is now officially a show-me story. Investors are saying, great plan, now go out and prove it.
All right, that brings us to the big finish, our thesis.
What do we think happens next? And how should you think about this stock going forward?
This is the million-dollar question, right? After sifting through all the numbers, the CEO's commentary, and the market's wild reaction, what's the most likely path for C3.ai from here? Here's our take. For next quarter, we think they'll probably hit the high end of their revenue guidance, mostly because those big federal deals will start turning into actual cash. But, and this is key, we think the stock itself is going to be stuck in the mud, probably trading sideways. The market needs to see more than one good quarter. It needs proof of life, proof of a sustainable turnaround.
And that's why we're slapping a market perform rating on it. Look, the promise of a turnaround with a new CEO is definitely there, but that potential is bumping right up against some very real execution risk, and frankly, a lack of anything to get truly excited about in the short term.
Now, for those of you with a higher risk appetite, there is let's call it a dark horse trade idea floating around. Remember that Reuters report a while back that suggested C3.ai might be looking to sell itself? Well, a speculative trade would be to bet on that happening. It's not a bet on the business improving, it's a bet on a buyout that could re-rate the stock overnight.
And as always, we have to say it, this is not financial advice.